I'm Joanna Simpson here at FundForum International in Copenhagen. Joining me now is Neil Capecci, Managing Director and Portfolio Manager at Manulife Investment Management. Thank you very much for joining me today.
Thanks for having me.
And just tell me, what is absolute return investing?
So absolute return investing is an approach in which you attempt to generate positive returns in any market environment. Now you can do this using many types of asset classes. But for the fund that I manage, the Asia Bond Absolute Return Strategy, we use the Asia fixed income markets to invest across the region to generate positive absolute returns. And when we don't see the potential for positive absolute returns, we focus on downside protection.
And why choose Asia fixed income for absolute return investing?
Yeah, so Asia fixed income is a rather unique source of absolute return management. But we think it's actually the best, or a prime source of absolute returns. The reason being is that Asia is not one homogeneous market. It's a collection of many different countries at different stages of their development cycle with different monetary policies and currencies. So at any given year, you can find opportunities to be both long and short the market. In fact, if you looked at, on a calendar year basis, the returns of, say, the 12 different market segments within Asia, the best performing and worst performing, and you take the average differential between the best and worst, it's usually more than 20%. So if you have the resources to identify the best opportunities to be long and short, you should be able to generate positive returns in any market environment.
And what are the opportunities in Asia fixed income?
Well, I think Asia really stands out on a global context right now because globally we're seeing, once again, negative yielding fixed income markets. Whereas in Asia, it's quite the opposite. Asia is still a region that is supported by strong fundamentals, strong growth. The sovereigns at the country level are still on an upward trajectory as far as being upgraded. It's an investment grade rated region, but despite that, there's still a bit of a risk premium there, and yields are higher than they probably should be based on the fundamentals. So, in the case of local interest rate markets, it's not uncommon to find real rates that's the nominal rate minus inflation of 3 to 4%. Which is unheard of on a global context. And on the credit side, you have corporate spreads that traditionally trade wider than equivalently rated developed market spreads. And if you have a large research team, as we have in Manulife Investment Management with more than 20 credit research analysts, we can identify those corporates that are going to outperform in the near to medium term and capture this spread differential.
So is Asia fixed income risky?
So one of the reasons why we see this, these higher yields or wider spreads in Asia is because there's a misconception of risk. When investors think about Asia, the first thing comes to mind is emerging markets, risky, or it's going to be more volatile. Well, it's quite the opposite. Though there is some beta risk because it does fall into the emerging market universe, it is by far the best part of the emerging markets from a fundamental perspective. As I said before, better growth, better balance sheets. But also, the volatility is much lower in Asia than it is in the rest of emerging markets. Part of that is due to the fact that there's actually a very large and growing local investor base in Asia. So Chinese investors, banks, insurance companies from other parts of the region invest in their own local markets, and that serves as an anchor for the region. So when we do see sometimes global risk aversion and volatility in EM in particular, Asia doesn't weaken as much.
And what are the global risks?
Well, right now, I think a lot of the global risks tend to be focused in Asia as well. So besides what we're seeing on G3 monetary policy with what the Fed's doing or the ECB, in Asia specifically, we have a Chinese economy that's slowing. And what the Chinese officials are doing to combat that slowdown is introduce more fiscal and monetary policy and ease some of the deleveraging efforts that were put in place in 2017, 2018. And compounding that is the growing trade tension between the United States and China. But for us, as absolute return investors, So volatility, in a sense, for us is good. If we can identify which market segments are going to be moving higher or lower, we really don't care the direction. As long as we get the direction right, we can produce positive absolute returns in near any market environment. So if we are in a heightened trade war scenario, we may want to be short specific Asian currencies or long specific rate markets that will actually benefit from that.
And of course, you mentioned this situation with China at the moment. What have been the main drivers of the fund over the last 12 months?
So the last 12 months have been fairly successful for the Asia Bond Absolute Return Fund. The reason being is, back in mid-2018, when we did have an introduction of higher trade-related risks in the region in Asia, and we saw a more acute slowdown in Chinese growth, the fund was positioned more defensively, and we had to focus on controlling the downside of the portfolio of the fund. We employed a lot of hedging strategies that were successful, so that when valuations became stretched from a long perspective, we were able to add exposure to some of the favored interest rate markets that we liked, like the Indonesia local rate market, or specific high-yield corporate issuers in Asia that were very attractive with the spread widening. So when those valuations came back to normal, spreads tightened, rates rallied, and then currencies performed well after that, we were able to actually capture the upside after we were looking to minimize downside earlier. So we've been very flexible with our approach and been successful so far.
Flexibility will continue, of course.
Absolutely.
Neil Capecci from Manulife Investment Management, thank you very much for your time.
You're welcome.